All right, this is your stock market crash course. We're going to get right into this and talk about what is a stock / the stock market, how to make and lose money, how to buy stocks, how to buy good stocks, too long didn't read, stocks only go up. So to start things off, we got this kid here. He's holding a Disney share stock because if you're watching this, maybe you've inherited stocks. If you're like me and you didn't inherit stocks, you're here to learn. So here we go. Basically, what that kid is holding is a building block of the Walt Disney Company. Now, of course, here you have like your three little shares that you would own of the company, and to the left, all the company stock together would make the whole company, and then this would be the market cap. So the market capitalization is the dollar amount of all the outstanding shares of a company. Now, that's a lot. So we're going to go over this. So basically, when you're looking up on Google, I would recommend you tag finance at the end. This brings up that little finance tab and brings up relevant information. But if you just type in Apple stock, the below part generally pops up. You can see the share price at 118 cents. And then if you look down here, you can find the market cap of Apple, which as of today or lately, it's at 2.01 T, T standing for trillion because they're a huge company. We can go quickly, and below market cap there, you have PE ratio, which is your price to earnings ratio, which that is something you need to look at if you're going to research stocks, but we're going to gloss over it now. Dividend yield, we'll go over that later. On the other side, you have open, high, low. Open stands for what the share price was when the market opened for that day. So you can see 118.61, and then the share price above is 0.03, so that's why you see that downtrend in the graph there. High and low is representative of the stock price over the past 52 weeks. So you can see that the high price was 119 and the low price was 118. Now, this is a quick equation that you should understand the nature of. If you're going to be dealing with stocks, you need to be able to take the share price by the shares outstanding. The shares outstanding of Apple were 17.1 billion. And if you multiply these together, that is how you get the market cap. So the share price times all of the shares is the value of the company. So that is how you calculate how big a company is. As you can see, I gave you the best example. Apple is a giant company. So now we're going to learn how to make money. Drawing a line down the middle, we got things you control, things you don't control. Of course, you can control when you sell. You want to sell after the stock price has gone up, hopefully. Now, when you sell is important because if you sell under a year, that is considered short-term trading, or even smaller within the day would be day trading. The reason there's a stipulation and is because of tax reasons, and that of course you can take up with your accountant. The other way to make money would be through options. You have call options and put options. These are basically options to buy stock in 100 share increments. So if you're going to buy a call option, you're going to buy the option to, you're going to buy the right to buy stock at a particular price. So you can have a call option on Apple and say that at a particular point in the future, say 3 years down the line, the stock price will increase to this dollar amount. And then you put a little bit of money down, and then you have someone on the other end who owns 100 shares of Apple who says, all right. And then in the future, that person would have the right to buy those Apple shares off of that person for whatever price you agree on. On the flip side, you have put options where if you pay attention to Tesla, as they have been going all over the place, you can put a put option that a stock is going to go down in price, and you would have the option to sell the stock, the 100 shares, at the price of today, right? So like say a stock is up, so we'll use this graph right here. So say today, in the moment, we're at the peak of that mountain there in the graph, and you have a funny feeling that the stock's going to go down, and you put a put option there, and then we teleport to quote today, the present day, say it's like 3 months in advance, right? And you see how like the stock price has gone down. You having a put option would have the option to sell stock at that higher price, in which you would make money. I kind of screwed up dividends. Obviously, you cannot control dividends. Dividends, what they are, is every business quarter, if a company pays out dividends, they will pay it out to their shareholders for holding stock. So over here, when we were talking about Apple, you had the dividend yield at the bottom, 0.69%. So whatever they're paying out in dividends times 0.69%, it's just money you get from the company that pays out dividends, which Apple pays out a dividend. So that means that you get money while holding their stock. Other things you can't control, obviously, the fluctuation of whether the stock rises or falls in price. But if it raises in price, you of course make money. There's such thing as a stock split. A company will announce a stock split in order to make more money. So right here would be an example of a 2-to-1 stock split. So you would have your shares that are worth 100, and now if you were to own that share after the stock split, your one share would become 2. So you would still have the same amount of equity, but your shares would become worth less. Now, the point of this would be to entice new investors to buy more shares, so that if they bought more shares at 50 and the price went back to 100, now you own 2 shares at 100 rather than 1. And on the flip side of this, we have stock buybacks, where say a share price gets down to like 36 or something. If the share price was at 50 or like 100 normally, and it goes down to 36 as a random number, a company could announce that they're doing stock buybacks. This is good for you because the share price will evidently go up, because the company plans to buy back as many shares as they can, which would decrease the amount of outstanding shares, which then would propel the stock price. And then you'd make money. And then, of course, if the company gets bought out, essentially what would happen is they would announce how much they're getting bought out for per share price. And then you would get paid out accordingly. So they would tell you, hey, so your share is worth $100 again. And they tell you that they're going to buy back shares at $97 a share. And then you make $97 a share. So we're going to move on here. Of course, you only lose money when you sell, but how do you actually lose money? Of course, when your share price goes down. We have GoPro here as an example. Downtrend. Some more examples. We have margin and options. Now, what margin is, if you take Fidelity as your traditional brokerage, Fidelity offers margin, and what margin is debt, and you can take this debt, you can ask Fidelity for some of their money, and you can take their money and invest it in, say, GoPro. Now, the issue happens when there's such thing as a margin call, and when this margin call happens, they will ask for their money back, at which you better hope that you have the money to pay up, where you could sell the stock that you used, or that you have to, so you buy the stock with debt, and then you hope that the stock price goes up, of course, but of course margin is dangerous, and if the stock price goes down, you're going to lose even more money because you're going to owe like half of your money to Fidelity, if not your own losses. Moral of the story is, don't touch margin. Your other thing is options. I just got done telling you that on a put option, you're betting that the stock goes down, and a call option, you're betting that it goes up. If the inverse happens, you lose money. The nice thing about options is that you only lose the money that you paid for the option, and like you don't have to execute the option. So if you buy a call option, you have to pay money up front for the option, and then when it gets it, so if you bought a call option on GoPro here, like you don't have to execute the call option and buy buy the shares at a higher price, you know what I mean? So basically that's how you make and lose money. And so now we're going to learn how to buy stock. You can look to your traditional firms such as Fidelity, but now with the introduction of Robinhood in recent years, they kind of shook up the market. Back in the day, you used to pay commission. So on top of what's going on? On top of having to pay for the share price, you used to have to pay an extra $5 commission. Well, thanks to Robinhood, not anymore. Now, all brokerages are the same. There's zero commission. So I kind of treat them like banks at this point, and it's really just your preference. I ended up choosing Charles Schwab just out of my friend's recommendation. It really doesn't matter. What does matter is the type of account you make. If you're saving for retirement, you of course want to go for a Roth IRA. This is for tax purposes, but this also limits you in the fact that you can't really take money out without penalty. So you can set up an individual brokerage, which is what I did. This is an example of what the buying interface looks like for Charles Schwab. At the top here, you got those buttons: stocks, ETFs, options, mutual funds. That's kind of how you go through things. I'm just going to walk you through how to buy a stock. So you would select your account. Now I have my individual brokerage selected. At that moment, I had $500 in there for my available cash investments. So, then you would look up the symbol. You would choose whether to buy or sell that, the quantity, and then down here we have our order type. This is where things might get scary, but I promise you it's not that bad. You have market, where basically earlier we looked at GoPro stock was $8 a share. So that price is fluctuating. And if you don't want to type in a particular price that you want to buy it at, you could just click market. I normally just hit market because if I'm going to buy stock, it's because I like the particular price it's at in the moment anyway. Now, if a stock is moving a lot, you have limit and stop options to choose. Now, a limit means that if you're buying a lot of shares and the price is going up, you can put a limit on where you want your order to go. So say you want to only buy GoPro shares at a limit of $9 a share. So it's currently worth $8, and then if it goes up, if it is at or above $9, that's your limit, and it will cancel the order. Now, on the contrary, you have a stop price, in which you would put in a price. So continuing our theme of GoPro, the price is currently at $8. You put a stop order at $6. So if the price goes down to $6 or below, it would stop the order and it would not buy the stock for you. Stop limit would be a combination of limit and stop, in which you set both prices. And then timing right below that, you have day only, good until canceled, extended hours, and other. Again, I usually just hit day only or good until canceled. Those are the two most appropriate options. And then you hit review order and buy. Now, of course, I get this nice field here, because in the nice field of stocks, we ask, where art thou, good stocks, that will always go up. And if you're going to try and do your own research, I have a wonderful resource here for you. This is for anything I'm doing that is not a obvious choice of a stock. We talked about Google Finance earlier. Another great resource is Yahoo Finance. When you're looking at stocks, you mainly want to look at stocks that have a lot of growth potential. You're going to want the share price to go up over time, of course. And if you can get paid along the way with dividends, I'd say that is your holy grail stock. Two examples of this would be Apple, of course. Apple is still growing today, and they pay a dividend, as I showed you earlier. So they would be one of your holy grail stocks. Another company that I like is Wynn Resorts. I don't know if they're much of a growth stock, but they do pay crazy dividends, and at least right now, in the current moment, they're going to go up like crazy because their share price is down. I would encourage you to always trust yourself if you believe that a company is going to go up in value over time. I was told to not buy Disney stock because, there's just no room for it to grow. But as you can see, I'm up 45%. So, say what you will. If you think you're making a good call, I would always tell you to trust yourself. Disney also pays a dividend. Some extra resources. Of course, we have Yahoo Finance. But you could also go out and find yourself a good community to follow on Reddit if you like day trading or just any investing. I'm sure you could find a friend on Wall Street's Bets. They're actually in the news because they're so popular nowadays. Another great thing is Discord. I actually am a part of this new Discord that's pretty good. Called Stock Hub. That's the Discord link, because you can't really look up Discords the same way you can look up a Reddit. This Discord is actually owned by this dude, Financial Education Jeremy. This is kind of what he looks like in his older videos, his like earlier ones when he first started out. And then this is a more recent video. This is kind of like what he looks like more today. I would recommend him a lot. He really, really knows his stuff, and with this Stock Hub Discord, he's just kind of growing a bigger and bigger pool of investors that really know what they're doing. And before I leave you, I would like to hammer down the idea that of course you're trying to make money, but you are more importantly trying to build and maintain wealth with stocks. And it is not an overnight thing. It'll take a couple years. I mean, even this graph with the Wall Street bets, see how long it takes for it to go up. I recommend you to be patient, never sell out too early, and yeah, it's as simple as that.